Hello, everybody, and welcome to another episode of the Olympus Wealth Strategies podcast. And I'm very thankful to have a special guest with us on the podcast, Kirk McDonald. He is the portfolio manager for Argent Capital. Ultimately, they run several different strategies, but Kirk is a portfolio manager for a couple of them. Quick background on Kirk. He's a graduate and former pilot of the United States Air Force. He's been in the industry for over 20 years and ultimately has been with Argent for the last, I believe, Kirk, about 12 years, 11 or 12 years.
Yeah.
But Kirk, how about you go ahead and tell the audience a little bit about yourself?
Okay. Thanks, John. And I appreciate you giving me the opportunity to be on the podcast. Yeah, John gave you just a quick update on my background. The two things I always wanted to do in life were be a pilot in the Air Force and be a portfolio manager and manage equity stock investment fund. And I'm incredibly fortunate I've been able to do both. I went to the Air Force Academy, spent about 10 years as a pilot in the Air Force, and then transitioned to this industry. And now I run the Argent Mid-Cap strategy and the Argent SMID-Cap strategy, as well as the Argent Mid-Cap ETF, active ETF.
Well, Kirk, maybe tell us, obviously, with you being in the business for the last 20 plus years, how has your investment philosophy evolved over time? Certainly markets have changed over time, but has your investment philosophy changed over that time period? And does your experience shape your approach today?
Yeah, I would have to say my experience shapes my approach in a number of ways, one of which is risk management. And interestingly enough, that goes back to my Air Force days. So risk management was invented for aviation. And the story behind it was, it took 30 years after the Wright brothers first flew for risk management to come into play with aviation. And the reason was Boeing's best pilot, their number one chief test pilot, went out with his crew to test fly the B-17 bomber. And they hopped in, they fired up the engines, they tried to take off, but the flight controls were stuck. And it crashed at the end of the runway and it killed that chief test pilot. They found out that nobody took the locks off the flight controls, so it was never going to fly. But from that, checklists were born, and it was the very first risk management tool. And that's just from day one, when you go to the Air Force Academy, risk management is pounded into your head. So that is a key thing that informs my approach to investing. And we build risk management into the entire Argent mid-cap investment philosophy.
Well, let's talk about that risk management a little bit, because one of your I would say kind of taglines for Argent, especially the strategies, is investing in enduring businesses. Can you kind of tell us a little bit what that means and maybe how that philosophy might be different from some other strategies that are out there today?
Yeah, sure. Enduring businesses is one part of our risk management approach. So for Argent, an enduring business is a business that has three characteristics. First of all, it's a business with some sort of durable competitive advantage that we can identify. And they have a history of being able to grow cash flows, as well as a management team that is a good steward of that capital. And what I mean by good steward of capital is I want to see them reinvest those growing cash flows back into the business at high rate of return projects. When they run out of those high rate of return projects, I want to see them give the money back to shareholders in the form of growing dividends and share buybacks. And these companies, because of those growing cash flows, that emphasis on capital allocation and discipline, tend to have very strong balance sheets. So that's the very first part of our risk management approach is that strong balance sheet, they can get themselves through the tough times in the economy.
Well, and kind of to piggyback off that, so the strategy that I'm most familiar with with your firm being AMID, the ETF, or used to, obviously still have the SMA. You combine both the quantitative tools that you mentioned there with kind of a fundamental analysis. Can you kind of explain how those two different disciplines work together?
Yeah. So for me, I'm kind of an interesting case in that when I first started in this industry, I was actually hired to be a quantitative investor. So to build stock selection models. And I didn't even know that quantitative investing existed at the time. I went to the Air Force Academy undergrad, then I went to the University of Oklahoma to get an MBA in finance. So I was very familiar with fundamental research and fundamental investing. I got hired in this industry to build stock selection models, which is essentially just groups of factors. And a factor, for people that are familiar, is just a characteristic, like you could say, return on equity that correlates with stocks that outperform the market. So I built initially a model of several factors to to pick stocks and ran a portfolio that way. And then Argent hired me 14 years ago now, actually, to build stock selection models for them that fit in with their enduring business philosophy, which was a perfect opportunity for me because that's the way I like to invest. So the enduring business is a company that has a history of growing cash flows, and then that durable competitive advantage, and then good capital allocation. So the way I blend these two disciplines in quantitative and fundamental is we have 25 factors in the Argent Alpha model, and they're all designed to help us identify these enduring businesses, and they line up with those characteristics. So for growing cash flows, we have a factor that helps us identify companies that are growing cash flows per unit of sales faster than they have historically. And then for a durable competitive advantage, one of the characteristics of a business with that is they have high cash flow return on assets. So cash flow return on assets is a factor in the model. And then for that good capital allocation, what we want to see is them be able to reinvest and grow the assets in the business and maintain the high rate of return. So actually measure that with a factor. And then when they run out of those high rate of return projects, we want to see them give the money back to shareholders in the form of dividend growth, which is a factor, and share buybacks, which is also a factor in the model. So we're able to always look for alignment between the good factor scores and the quantitative at the company and the fundamentals at that company. When we find that alignment, we call that nirvana. That's where we get our good results from.
And talking about that nirvana, right? And talking about the fund I'm most familiar with AMID and several clients is, you know, there's you could call it a concentrated portfolio in that ETF of roughly 40 to 50 names at any given time. And kind of what you just said, there's a lot of screening that goes into place, both from those different factors that you applied to find those enduring businesses. Can you maybe give our listeners a little bit of understanding of maybe how many companies that ultimately you have to scrub through, like for instance, the Russell 2000 most people are aware about, and how many companies just really you can scrub out pretty quickly from that index before you really start to find these nirvana companies that check the box?
Yeah, so it actually, having this blended approach of quant and fundamental makes that very easy and very systematic. So for the mid-cap equities, which you would say typically maybe a $2 billion to $20 billion market cap, where I look to buy them, there's about 1,500 of those companies. And what I do every month is I immediately screen those down to the names that score in the top 30% of the Argent Alpha model, because on average, they historically outperform. So I know I'm fishing in a good pond. And then so you're already down to just 500 stocks. And from that, I'm able to go through and just double check, okay, which ones fit like our enduring business philosophy. And I look at the factors that they score well on, and then I check in, okay, what is management talking about in terms of their strategy, their business strategy, and looking for an alignment between their strategy and those positive factor scores. And that gets you down immediately. There's only going to be, 20 stocks that I haven't recently looked at that might fit that and have that alignment between a good quant score and their business strategy. And then we can quickly really kind of get those down to just 2 or 3 that we want to do a deeper dive on that month. So our approach lends itself to very systematically getting your universe of possible investments down to just a very few number of selective companies.
And you kind of, Kirk, specializing in that mid-cap space, can you maybe inform our listeners maybe why mid-caps tend to get overlooked or not as talked about much in the media as maybe larger small caps, and maybe why mid-caps might look attractive right now and how you see them fitting into a larger portfolio?
Yeah, oftentimes I think of mid-caps as like the forgotten asset class. It's sort of like, middle has a lot of negative connotations, like you get stuck in the middle of nowhere kind of a thing. And it does get overlooked because people feel that they can get their allocation to mid caps by just investing in some of the larger caps up there, like the Mag 7 that everybody talks about, and maybe blending in some smaller stocks as well. And then you've got this large and small mix that averages to the middle, and they miss this entire group of 1,500 to 2,000 stocks that are the mid cap marketplace. And that gives you really good opportunities to have alpha, because these companies are overlooked. There's fewer people paying attention to them. There tends to be fewer analysts on Wall Street covering them as well. So you're able to really find some wonderful businesses that are selling at reasonable valuations, and it lends itself to just a good spot for active managers.
Well, Kirk, maybe talking about, active management, but also in particularly in your specialty in the mid-cap space, obviously a lot of clients, and I would imagine a lot of your end clients are kind of asking the same thing. Hey, there's a lot going on right now with potentially some slower growth on jobs reports, maybe some stickier inflation, potentially shifting Fed policy. What's going to happen with, some of the kind of legal ramifications with tariffs? That's kind of, I guess, yet to be seen. How do any of these dynamics maybe affect the mid-cap company space versus their peers in large and small cap? And maybe why is that even more important when it comes to enduring businesses?
Okay, for the mid-cap space, they have a couple of advantages over both large and small. So over the large cap space, one of the things I've noticed with my mid-cap companies is most of their revenues are derived more domestically than the large cap companies that tend to get a good percentage of their revenues internationally. And they also have a lot of their manufacturing international. So they're right now being much more negatively impacted by the tariffs and trying to figure that out right now. Whereas the mid-cap companies aren't being hurt by that. The companies that I own, for example, there's just a 1 or 2% impact to their expenses from tariffs that they're easily able to overcome with just mainly taking care of some costs, other cost out opportunities, and getting more efficient. And then the small cap companies tend to have essentially less access to capital, so it's tougher for them, especially right now. Interest rates are higher. They haven't come down yet. Even if they do come down, I doubt that they'll come down to where they were a few years ago, near zero. So mid caps are advantage over small caps in that they have easier access to capital in terms of tend to have higher credit ratings. They can borrow money at better rates than small caps. So it's really going to help them to get the capital they need to grow their business. And then coming back to the enduring business idea for Argent, where we're looking for companies that have this ability to grow cash flows and self-fund their business, so they don't need to issue a whole lot of debt in order to fund their business. So they're naturally advantaged that way. When the economy is slowing down and times are getting tougher, these enduring businesses have a proven track record of being able to continue to grow through that and fund their business and come out the other side of, potentially a slowing economy or, worst case, a recessionary environment.
So, Kirk, would you say that maybe with all these different dynamics that are playing out right now in the economy, are there maybe some sectors within the mid-cap space that you're able to find more enduring businesses in today's age than others? Or is it still pretty wide gambit of just, it really depends on, like you said, the fundamentals of the management and really how they're deciding to run their company?
Yeah, so for us, we tend to be very bottoms-up investors. So it's more of a company by company type of a basis. But historically, with the Argent Mid-Cap strategy and AMID, our ETF, we tend to be overweight industrials and information technology almost all the time. And that's because we can find a number of enduring businesses in each of those economic sectors. Plus, you can build a pretty diversified portfolio of these different industrial companies that have different end market exposures. Everything from residential construction and non-residential construction to building out AI data centers to consumer discretionary type of products. And it's the same thing.
Even though they're in the same sector, very, very diverse, even within the same sector group.
Exactly. Very diverse. So you can really find a good way to spread yourself out or diversify across different economic cycles. So the trucking cycle versus the construction cycle versus the semiconductor cycle are all different. So that's one of the reasons we tend to be overweight those two particular sectors, is we are able to diversify our exposures in the portfolio. And that's another approach to our part of our risk management approach. And then there's some sectors that historically we haven't found as many enduring businesses in. And that would be, we tend to be underweight real estate investment trusts. We tend to be underweight consumer staples. And until recently, we had never owned a utility, actually, because they're heavily regulated and you really couldn't find a competitive advantage. Until now, we actually own our first utility because of really the data center build out, and just there's actually a shortage of electricity for the first time in a very long time in North America. So you can find some utilities that are very well run and I would argue now are enduring businesses.
I think that speaks right back to the active management component, right? It's if you're just owning the index out of the 1,500 names, you certainly can get exposure there, but you're also owning maybe a lot of companies that that certainly wouldn't fit the bill of an enduring business or have strong cash flows or strong financials, but ultimately being able to sift through that and find those, even if people might on the outside go, oh gosh, Kirk, your portfolio making this number up, but has 10 out of the 40 in industrials. Well, hey, maybe those 10 have all very different end products and end businesses and end consumers, that it's really diversified amongst the whole group.
That's exactly right. That's a good summary.
Well, in talking about maybe different indexes, different indices here in the market, I know I hear it. I would imagine you hear it as well. I think people are becoming more and more aware. I don't know if maybe concern is the right word, but certainly more and more aware of how concentrated the different large indices are becoming, whether it's the NASDAQ or the S&P 500, and the talk about the Magnificent Seven. Do you see mid-caps as a way to, maybe you alluded to this a little bit earlier, successfully diversify away from that mega cap dominance, but still find some alpha for outperformance?
I definitely do. So the mid-cap benchmarks don't have that problem with becoming concentrated of just a few names at the top that really make up 30% of the benchmark weight, and wherever they go is where the benchmark goes. So you don't have that issue with mid-caps at all in the benchmark, and you can find businesses if you want exposure to what's happening with the Magnificent Seven, which is a lot of the artificial intelligence build out and things like of that nature. You can find the companies that are benefiting from that within the mid-cap space. One example of that would be Comfort Systems that we own. It's a company based out of Dallas, and they actually install the HVAC systems, the electrical systems, and the data centers, and their business is just booming as one of the larger contractors, and actually I think the largest contractor in the country that does HVAC and electrical installs, and they have their competitive advantage right now is, if you ask them what it is they have the workforce, they have the people, the plumbers and the HVAC technicians, and they've been working on building this business for 30 years. So their competitive advantage is they actually have the people that know how to do it. So you can get exposure to that AI build out and data center build out in a mid-cap company.
Well, and talking about mid-cap companies, maybe how do you see the next few years as economic cycles? I know we're saying, economic cycles always are normalizing, right? But as we go through just another phase of what the new normal is, maybe how do you see the role of mid-caps, in particularly, like you mentioned, some of the factors that go into what makes up an enduring business, the quality of the company, the cash flow, the capital allocation. How do you see maybe that fitting into this current and future economic cycle? And is there anything that you're kind of really looking out for there?
Yeah, so I think that emphasis on enduring businesses very much helps us right now, and it goes back to the fact that if you're growing your cash flows on your own, so you're generating free cash flow every single year and increasing that, so you're able to self-fund your business. That gives you a big advantage should we run into a tough time in the economic cycle. That gives you a huge advantage to get through that. And it's also an advantage over the small cap space that the smaller cap companies tend to have less access to capital, and they tend to do much worse in a downturn, in an economic recession in terms of their returns in the small cap benchmark relative to the mid cap benchmark. And I think that gets back to something I probably could have answered better before when you talked about what are advantages of mid caps over small and large. Is historically over a long span of time, the Russell mid cap benchmark has been the best performing domestic asset class. It beats the Russell 1000 large cap and the Russell 2000 small cap. And the reason for that is mid caps are typically never the best performing asset class for any given 1 year period of time, but they're also never the worst performing asset class. And just that steady performance allows them to come out ahead in the end. It's almost the turtle wins the race sort of a thing. And that's why right now, so if we are going into a recession, I'd anticipate that small caps would struggle and do a little bit worse returns wise than mid caps. So we'll outperform them now, and then coming out of this will, coming out of this, the next recession, should we have one, they'll tend to hang in there and keep up, with small cap stocks on the way up.
Well, and it kind of reminds me of what you just said, right? That quilt chart that we all tend to look at, right? Hey, you're never always going to be the top performing year over year over year, but you certainly can average out to be a great performer and enhancer over time. But what you just alluded to right there, Kirk, maybe different economic cycles, whether it be positives or downturns. Where do you see maybe the biggest risks for mid cap investing over the next, call it 12 to 18 months? And are you anything that you can share with us? Are you making any changes within the portfolio to position for that?
So the biggest risk is always, would be some sort of a recession, a recessionary environment, right? So the way that we position the portfolio is essentially by always focusing on these enduring businesses. So we're very much bottom up. We don't tilt the portfolio or change it based on an economic outlook, but by focusing on these high quality companies that have low levels of debt, and part of being an enduring business has been able to show a track record of decades prior to us investing in you of being able to navigate different types of economic cycles successfully. So for me, the number one thing I focus on is really high quality companies that are growing cash flows, generating free cash flow, and then allocating that appropriately, just reinvesting back in the business, a good rates of return, and then giving you the extra money back. But that's the number one thing, is really just being bottoms up and focusing on your discipline of high quality businesses.
Would you say that's maybe something for investors to consider as they look throughout the rest of this year and into next year, is really understanding where we're at in the economic cycle and kind of reanalyzing your portfolio to see, do you have any exposure to this particular sector and asset class, and how is my portfolio positioned overall, from whether it be mainly enduring businesses or maybe companies that are a lot more highly leveraged?
Yeah, I would definitely. So I think in the long run, if you look, also high quality companies tend to do the best. They outperform over any long run span of time. And by high quality, it's generally, you can say, low levels of debt on the balance sheet is just the easiest way to think about that. They tend to do the best, and I would focus there because so especially if you're concerned about like the economy slowing down, heading into a recession for one reason or another, these high quality companies will hold up better and through that environment, and really you can avoid a lot of the worst outcomes that way. So that's a key thing that I always stay focused on from a risk management standpoint, and also I know from an investor standpoint, the pain of loss is greater than the joy of gains. So I always try to manage the portfolio so it has less downside capture than the market, meaning it just, we're always 100% invested in stocks. So if the stock market goes down, we will go down, but I want to make sure we go down less.
Yeah, which plays right back into the component of active management.
Yes.
And maybe, Kirk, is there anything you can kind of share with us as far as are there any opportunities and anything that is really exciting you and your team as it comes to the strategies that you run?
Well, I can talk about some of the companies that we've added to the portfolio recently, if that is
Absolutely
interesting. Okay, so there's been a few ads this year, and one would be, I guess, the utility company that we added. And I've never owned a utility in 23 years of being a professional investor, but we bought NRG Energy, company utility based down in Texas that sells electric. It's an independent power producer, so it's an unregulated utility that produces power for the Texas market primarily, and then up in the Northeast and Midwest area. So from Washington, D.C. north all the way up through New England, and then west all the way through over to Illinois. So they serve two main, very large markets. But both of those areas, Texas and then especially the area around D.C. and Ohio, there's a huge data center build out occurring. And NRG is uniquely positioned where they already have the generation capacity there, and they have excess capacity to sell to the data center people. But they also have a lot of greenfield space, meaning they own a lot of acreage around their existing power plants where they can build out and increase that capacity. So they're increasingly, they're actually co-marketing. They're marketing their land, right next to their power plant, and then they can throw in another, another generator, for the utility or for the data center company. So they're actually kind of marketing their land, and we'll build a new generator for you right here. And they have a deal with GE Vernova to get the numbers of generators that they need from them. So it's actually, and that would be for natural gas generation. But right now, it's tough to get actually space on the manufacturing line to get a new generator, but they've got a whole bunch lined up. So they have this competitive advantage, really, essentially, just in their ability to build out more electricity plants right where in the geographies where the data centers are going. And electricity rates, as we all know, we get our electric bill every month. I'm sure everybody listening to this podcast is feeling the same pain that I'm feeling.
Definitely coming off the heat wave in the summer for sure.
Yeah. So that's a unique ad that, that I'd never expected to buy a utility. So that's one of the companies we added this year. And then another company that's not as sexy, but it's Manhattan Associates. They sell supply chain management software, so warehouse management software and things of that nature. And their primary end market is retail. So about 9 months ago, when Trump was started to talk about putting tariffs on, people thought, oh my gosh, most retail goods are imported. It's going to send their price through the roof. People won't be able to afford to buy them. So retail sales will go down. So since Manhattan sells their software to retailers, that stock went down 50%. And there was actually no reason for that. It was just fear. We've been watching that name for years and years. It's a truly enduring business. And that gave us the opportunity to add Manhattan Associates to the portfolio. And that's just one of the things we try to take advantage of during times of panic is just staying calm and picking up these wonderful businesses that we've been watching for a while.
Especially ones where, the market has maybe mispriced it and just maybe due out of emotion as opposed to rationality, and allows you to pick it up at a great price to be accretive to the portfolio.
Absolutely. Yes.
Well, Kirk, we really appreciate you coming on, obviously sharing not only your insights, but the story of Argent. And we're thankful for your partnership and thankful to have you on the podcast.
And John, thank you for having me. I'm happy to come back anytime.
Awesome. Well, Kirk, hey, thank you so much. And to all of our listeners, thank you for listening to another episode of the Olympus Wealth Strategies podcast, where we help you take your finances to great heights. And we'll see you on the next episode.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.